Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Cucchiara, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Cucchiara.
Welcome in. Good afternoon. Joe Cucchiara with Real Estate Radio Live. Thank you for those that are following us on Facebook with the live feed. We appreciate that. We've had a little difficulties from time to time the last couple of weeks, but that is technology, and I think we have it fixed. So, again, appreciate those that are following us on Facebook. We want to continue to grow the audience as much we can in any different areas that we can. However, it is a podcast, so if you have not downloaded the podcast yet, please do so. We would love to have you do that. Follow us at any time at your convenience. You can get the podcast just by entering in Real Estate Radio Live at iTunes, Google+, Stitcher, anywhere online, really. Just enter in Real Estate Radio Live, and you should be able to get the podcast downloaded. That way you could follow the show. The focus has been the same for almost 8 years. Hard to believe. October will be 8 yeyears.
You're a veteran, man. I mean, you've been doing this, and you're consistent, and, you're in the major leagues now here. 8 years, you're probably one of the first 100 that were out there.
I think so. Yeah, and it was a good conversion from live radio to podcast, and obviously more and more people are drawn to podcast for obvious reasons. It's more convenient. Listen to it when you want, at your convenience, right?
I am amazed at what the range of subjects are that are covered by podcasts.
Yeah.
The way that's grown over time and the way in which millennials and others like to listen.
Right.
Including, I think, a lot of folks that are older that they don't read as quickly or their eyes get tired, and they're open to it. And it's surprising because I remember when I learned about the whole podcast era before people learned about it, and I said, boy, are people really going to want to do that? And people were like, yeah, they're really going to want to do it. And, this is back in the day when the Internet was not as fast. And they said, the Internet's getting a lot faster. And, now at 5G, we're talking about downloading 2-3 hour movies in 2 to 5 seconds.
No, it's amazing.
I mean, it's all getting faster.
I think the other benefit is, especially around here where all of us are on the road a lot. I mean, look at the convenience of listening to a podcast while you're driving down the road or in a meeting.
I was on a plane visiting my mom, as
there you go.
back to Florida. I was listening because there's a few that you press the button, you kind of get it queued up, and you turn that on, and you get really interested in the subject, and the time just flies.
Yeah, that's good. So we're going to continue. As most of you know, last year, Jack and I started the series, Starting Something New in Silicon Valley. It was a lot of fun. I think we got a lot of great response from it, too, and really just took people through A to Z. I mean, what it takes to start a company, you can imagine. This year, we're kicking off growing a business now.
Growing a business in Silicon Valley and beyond, and really the idea was germinated from the first book that was done about starting something in Silicon Valley. And the goal is then to do a second book, which, of course, we give away for free to those who write in that want one, and we enable a download as well. The goal really to say, look, you've started a company, maybe you're getting into your first anniversary, maybe even your second anniversary, and growth is finally starting to kick off.
Right.
What are the issues that inevitably will come up, and how do you best face them? And we've covered a few interesting topics, like the one last time about finding talent and using an outside agent to get that talent. And we brought in Andrew Gardner, who did a great job talking about that. And today, talking about how to use incentives like stock options, other incentive programs, including several that are quite interesting because they're becoming more normal in the way people use them, in which people are enabling effectively a special bonus plan if the business gets sold and your stock really hasn't gotten vested, or your stock options haven't gotten invested, because, of course, you can accelerate all that vesting, or you can say, well, maybe there's just certain retention bonuses, because remember, that team needs to stay with whoever acquires it. And the big fact of life that sort of makes this highly relevant is lots of businesses are not going public. They stay private, and they become unicorns, billion-dollar valued businesses, often with zero sales. I mean, there's examples of that.
Right.
Magic Leap in Florida is an example of a company. I'm not sure. Well, maybe now this year it's had a few sales, but it was a unicorn without any sales.
Right.
And people were amazed by that. But again, it's coming out with something that is believed to be the replacement for the handset cell phone.
Yeah.
So instead of looking down at the cell phone, you're going to have glasses on, and you're going to have constant connection to the internet. And if you think that's going to play out, that's clearly $1 trillion market. It's a huge market.
So this is a really important, I mean, it's all important, Jack, but this is important because, you know, you issue shares, you have shares in this corporation. Obviously, investors, there's the dynamics of, you know, raising money, right? There's some of the shares are used up by raising money.
Right.
So are we going to talk about that, or specifically how to use shares, or in general you want to cover both those?
Let's cover both, because if you think about a company, when you start it, and let's say it's you, Joe, you start a company and you're the sole owner and you're the founder, you're everything, and the pie is all yours. It's just a really tiny pie.
Right.
Because you started it, and you may have started it with as little, and this is the magic of Silicon Valley, you can start a company with like $0. Overseas, the European lawyers and lawyers elsewhere throughout the world say that's crazy. You shouldn't be allowed to start a company without having some real stated capital, because of course this whole notion is you're going to get limited liability. Your liability as an individual is going to be limited to the capital that you put in. So since you have some capital, and the magic of Silicon Valley is you can put intellectual property, or even potential intellectual property, an idea, a business plan, a domain name, something that has some expected future value into that vessel, and maybe like $1,000 to cover the various filing fees. Years ago, we used to say, well, you really should do at least 5 or 10 because there's going to be legal and accounting and other fees. And of course, now lawyers and accountants are taking stock and stock options in exchange for deferral agreements and all sorts of discounts and whatnot, sometimes waiving fees depending on what the opportunity is. So you've got this little pie. It doesn't necessarily have a lot of cash in it, but it's got an interesting idea, like this idea from Uber, which is, hey, we're going to make it so that you can literally use your smartphone to call what was previously thought of as a black car type driver, a limousine driver. We're going to make that low cost. People were like, really? Okay, that's an information system. Are you going to employ people? No. Are you going to have cars? No. How are you going to make this work? We're going to raise a bunch of capital and lose a bunch of money. But we're going to break a lot of glass.
I'll tell you what, it's a brilliant idea, though, isn't it?
It's brilliant. And, you know, a lot of that story has not yet fully been documented. I guess a lot came out in that litigation, but I think a lot more will eventually come out over time. But you've got this little company, so if you started it, let's say, like, 8 years ago, you started this podcast. I guess you could have put it into a separate little vessel. But let's just say you started in 2008. And it's just this little thing. It's just an idea. There's not a lot of money in it. So maybe the value is like, how do you value it? Well, it's not a huge value. Let's say you're conservative. You say it's $10,000. Not a lot. $9,000 worth of intellectual property value and $1,000 worth of cash, because you got to pay a bunch of expenses. And then over time, when you look at the picture of the next 10 years, what is it going to look like? You're going to start building that website, adding, what are you up to now? How many podcasts have we had?
Over 10,000 downloads a month.
And how many actual podcasts out there?
What are we at, 1,600 or something like
16.
that?
Yeah, I mean, a huge
over
number.
1,600.
So every week, every day, every other day, you're adding more inventory, more range of topics. So you've now got this larger value entity, usually the growth in sometimes within even a year, and podcast businesses may be different, but software businesses, it easily goes anywhere from 10x to 100x in a year. So that 10,000 is going to become at least 100,000 to 1 million. Now, friends of mine would laugh and say, are you kidding me? In a year, we're going to be worth at least 5 million. In fact, that startup that came in the other day, and I think they're at the formation really at the very, very beginning, but they think they're further along. And I said, so what do you think your value is? You got a domain name, you got a business plan, you got sort of an idea for a product. Oh, we're worth at least 5 million already. I said, well, wait a minute. You really want people to put in and expect that there's really $5 million of value? He said, and we were laughing about this, Andrew and I, when we did the show. We were like, there are AI people that think for every AI programmer you get, if you have 5 of them, it's $1 million ahead. That's $5 million. So if that startup team, and of course, then I was sort of reminded that, well, if you do that math, then if you get 15 people assembled, you're at 15 million. So of course, the next startup we see is one that had 15 people that were AI people, and they were like, we're thinking we're like multiplicative effect. That startup we're like maybe 25 million, because if you can group the team, and there is a certain logic to if the team works well together, and if they really know what they're going to do and they act with purpose, maybe there is a lot more value at startup. And maybe the truth is Silicon Valley is changing what we used to think of as, hey, you're really at the early stage. It's more like, no, if you're going to get an outside investor, they're going to pay a lot more for their little slice. So traditionally, when we said, okay, this $10,000 thing became $1 million, if your first raise, sometimes called the seed raise, is, let's say it's a 10% raise, you're going to raise like $100,000. Today, people would be like, that's peanuts. You're going to raise more like $1 million, or at least $500,000. And in fact, there'll be a lot of people who say, don't even bother not raising at least $500,000, because the money's going to be needed, and you're in a race. And so over time, as you're doing this growth, and of course it keeps growing every year, there's a new valuation that the board has to do, and in fact there's even now a special accounting rule and a special IRS rule that says you've actually got to get an outside party to provide an appraisal under Section 409A, because it can't just be the board of directors saying, well, we put our finger in the air and we think the number is this. You actually have to use some metrics that are kind of like comps in the real estate business. So here's the first big point. Employees want to get in, and other people want to get in early. And they would really like to, in the ideal case, buy some shares. And they usually buy some shares with cash or with intellectual property or other contributions they give. And then they're kind of riding with you. But you want them to be vested. You want them to not go away. You want them to stick with the program. And the typical vesting program, and you hear this all the time because people work with certain expectations and customs, is typically 4 years. It can be shorter, particularly with people who are outsiders, but typically for an employee and even for a founder. Even founders will often be put on a vesting program. I've had founders where they grew the business for a while, and then the outside VCs came in and said, we know you own, on paper, 60-70% of the company, but we actually want you to agree that if you leave, you lose half of it. And the founder's like, what? And they're like, look, we're not putting this investment in if you're not harnessed. And sometimes they'll even say, we want you to lose all of it. And we want you to be really staked to the outcome. So this vesting idea of 4 years, and it's usually not, the first year is usually a cliff, which is if you don't stay at least the first year, you get 0. And then after that cliff, after the first 25%, the next 75% is typically over 36 months. I like to say you might as well let the person have 28%, just to use the numbers, and then let it be more like 2% per month over 36 months, because that's easy to round. But of course, you'll see people say, no, that's not traditional, and you're giving the person more than what they deserve. And I just look at it saying it's a lot easier for people to see that they're vesting. Now, I've seen some deals that go out 5 years. I've seen some deals that have been as short as 3 years and some that have been 2 years. It's all negotiable. But usually if you're hiring a lot of people, you start to set up standards. And that's all built into a stock option plan. So the stock option plan dedicates a certain number of shares, typically common shares, typically at the lowest true fair market value, conservatively looked at, not what the outside investor. So the magic of Silicon Valley, and it's really true now throughout the United States, is you're giving the insiders less expensive stock with greater upside, but they're taking greater risk because the outsiders, the insiders are getting that deal. The outsiders are getting some type of preferred share, some type of share that, look, if things go badly, your money gets paid first. Now, we all know for most software companies in particular, but internet companies, usually if it fails, everything fails.
Right.
Because it's not like real estate. Well, the
Right.
dirt will always be there. The
True.
business might fail,
Yeah.
but the building will still
Right.
be there. But software, typically, if you see most software companies that fail, they fell in a big way.
Yeah.
There's usually nothing left. Even
Right.
the computers that were leased have to go back to the leasing company.
Yeah.
And typically they're highly leveraged. Like they lease everything. The real estate that they take, usually just a lease. Sometimes the
Right.
lease goes up in value, but rarely. There's all kinds of situations where there's very little in the way of anything that has any hard asset value. So for that reason, it's actually highly risky both ways, but still the way in which it's looked at from a tax point of view is, hey, that outside investor has a preference over the asset, sometimes called a liquidation preference
Right.
for the preferred shares. So if you're an employee, now looking at it from an employee's point of view, they want to be in for as much as they can own, and they want the vesting to be as short as possible. Why? I'd be amazed by the number of employees I see that say, and this is sort of insight number 2, they're like, look, I don't know if this company is going to be around. I may stay for 2 years, get 50% of my shares, and then I'm going to diversify my own portfolio, buy those shares if I think they're worth something, and then go to the next company. And I have to tell you, this is the big risk for Silicon Valley and elsewhere with AI people that may jump from one company
see that.
because they're like, these AI startups, if I get a sign-up bonus and I get 50% of the shares, then the next 2 years I can do the same thing. And over what might be I used to say 20, but maybe it's becoming a 30-year career.
So are they, on a side note, they seem to be the new, I won't say shiny nickel more than that, but the new hot commodity. The AI people used to be everybody was after the top engineers. Remember, software developers, and now it's AI.
It's AI and data scientists, people that understand that data is the new oil, and data has become the compilation data, like the compilation of all these podcasts. It's become amazingly valuable, particularly if you could point a computer at it and extract valuable information about the data. So I like to say the real business of Uber is not driving people around.
No.
The real business of Uber is it's a vacuum cleaner for data.
Right.
So Uber, think about it. Let's say you have the business model, and the business model was we want to collect a lot of data because it's going to be relevant for maps and relevant for consumer behavior and relevant for traffic patterns and a million different potential use cases, right? And somebody says, well, if we're going to need like millions of drivers and they're full-time employees and we're going to have payroll and obligations and we've got to manage them and they're going to be traffic accidents and insurance issues, well, why don't we just do this? Why don't we raise a whole lot of money and then just lower the costs and get the drivers to make them run their own little businesses, and then the data is ours. We own the data. And they're the vacuumers. They're vacuuming. They're sweeping it up for us. They're doing it through an app that we provide, and, they give up their rights if they ever really had any. They're driving the car around for what they believe is revenue and tips, but they're like employees from the data point of view. The data rights are all moved to Uber, and that business, and they're all competing for that future of the driverless car, which is going to depend on that data, the future of shopping patterns and traffic congestion and probably a million other things that data is going to hint at. And more, I think people are starting to realize that there's way more valuable in the data than there is in anything else.
If someone starts a company and they've done it before, they're probably going to be more likely to understand the format and the distribution of shares and kind of what the likelihood of is what you give the executives versus employees and so on. But what's your recommendation, obviously? Now, a lot of companies start with your firm as a startup.
Yes.
Someone starts a company and they have no idea about this, right?
Well, they would typically have some advisor beyond me, but me included, who would say, well, look, you're overcompensating or you're undercompensating. And it really depends on the talent. But there are certain standards for when you get to certain stages. So, for example, right now, we helped start a company. It was actually more than 10 years ago. And they sort of followed this model. And eventually got some big venture capital and doing quite well, and they're getting now to the point where they may soon be $1 billion company, not public, private.
Yeah.
And the big issue is, well, where do you go from there? Do you go public because now you've got a market where Uber and Lyft and a host of other companies are all filing like they're going public, and if the market stays as bubbly as it's been, they probably will.
Yeah.
And they're talking about huge public offerings, big numbers, right? So the question then becomes, okay, well, now somebody comes in and says, I want to join as your executive VP in charge of business development, a slot that, you know, somebody left maybe after only a couple of years of vesting.
Right.
What kind of stake do I get in your company? You can't give that person 1% of $1 billion company.
Right.
That's overcompensating.
Yeah, that's a good point.
Right? So you've got to look at, well, what's the value of what's here?
Right.
And what's going to enable some incentive so they feel good about growing it to the next, whatever the next big goal is, like making it a $5 billion company and making their stake worth 5x.
Right.
So as the company grows, it actually gets more difficult to use stock option currency or stock currency because it's too expensive.
Yeah.
And that's when you start getting to these alternative plans, like these cash-based, sometimes called phantom equity plans, or sometimes called phantom incentive plans, because they don't actually give someone a stake in any securities. They give them a future bonus conditioned on future events.
Okay.
And a lot of people don't understand that. They see something that says, you know, phantom or equity or something else, and they just don't understand, well, what is that? Well, it's really very much in the text of the document what it is, but it's really designed as, we want you to be incentivized that if this business sells for $5 billion after you arrived, your cash bonus is going to be 5x some base number, because you're helping grow this business.
Right.
So sometimes you have to reset this. If the business has setbacks, you might have to reset the numbers and set different goals. But it's kind of like what people do with sales quotas.
And then you have the element of when you bring on CEOs or executive people, right? Because those comp plans are completely different than the stock options than an average employee sees, right?
That's right. So there's certainly classes of people and top-notch CEO talent, very rarefied, particularly for public companies. I mean, we're seeing it even now for, I about fell off my chair. I was reading this article that talked about how much different general counsels made for public companies. These are the lawyers inside public, and the numbers are getting to annual compensation north of $10 million. I just about fell off my chair. I was like, I went to law school with that person. They didn't even do that well in law school. But you laugh because you say, well, there's a certain incentive to attract the best talent.
Right.
It goes across the entire C-suite. It's not just the CEO.
Right.
It's the chief technology officer, the chief sales officer,
chief marketing
officer. They all have C titles.
Yeah, they do, right.
You know, and they all, now it's called the C-suite.
Right.
And they're all very highly compensated. And of course, they have to work well together to make it all work, because if they're not pulling together with the same degree of strength on those oars, the business may not do as well as it can do. And of course, the better teams typically do far better. I mean, look, people like to talk about Amazon as, you know, Bezos owns it. He doesn't own the whole company. I mean, his wife owns at least half of whatever he owns, right? Right. But if you look at the big picture, he had a team around him. That team had to be incentivized. That team still has to be incentivized. That team is making stuff happen. I mean, they decided to target New York, and I guess the thing in the newspaper today was New York said no, or they said no, or local people said no. But I just
depends
look
what
at
side of the fence
you're on. I have
on.
to tell you, I was a New Yorker for many years. I mean, I could tell some great stories about New York. I have and probably will in the future, God willing. But at the end of the day, you know, New Yorkers should have welcomed them. New Yorkers should have said 25,000 new jobs. Hey, let's go.
Some tax revenue.
Let's make it happen. And, you know, Blasio was in the news saying, yeah, we really wanted them to come, but it didn't work out. And I'm just thinking, just make it happen. I mean, this should not be. And I'm thinking probably there'll be some second other city, they'll say this was a blessing.
Well, I hate to say, we won't get the show involved with politics,
Yes.
but that is amazing. To me, that was a clear indication of politics at play.
Well,
the new regime.
regime.
They're saying, no billionaires could push us around, out of ego.
And we don't want change. I mean, part of it is there's a reluctance, and you see this often, particularly in, cities that are a little less with it. I'm sure there'll be people in Kansas that'll be, we're all over this, man.
Yeah, absolutely.
Come here, we'll make this happen.
Right.
And they're looking at things, and I'm sure it was disappointing for that team, but that C-suite spent a lot of time figuring out where to put that next main office, headquarters, whatever you want to call it. And I'm sure there are people thinking to themselves, wow, how did we not get that right? We spent so much money. Didn't we have a pulse on what was really going on?
Right.
So the third point I'll make is the at-will doctrine. This is an important point about stock options, vesting. People get confused about, well, if I have this vesting program, doesn't that mean I have tenure? Doesn't that mean that I get to stay the full 4 years? I see this all the time. People come in, often they want to stay, but they're being asked to leave, and they're like, I'm so close to the 1 year.
Yeah.
I'm so close. Can they do this to me? And the answer is yes. If you've signed an at-will agreement and they are terminating you without some discriminatory intent or some wrongful retaliation or something that violates other rules, if they're just following their at-will because they get to decide, management gets to decide who plays in the game.
Right.
And you want the best players on the field because it's a competitive environment.
Yeah.
And there are a lot of people that come in and say, I'm so close, I'm so close. And sometimes they are so close that you can make an equitable case for giving them the vesting and then, negotiating a bunch of other stuff as part of that exit. But as a general proposition, there's no tenure that arises from the grant of a stock option or from the grant of a stock plan type stock grant. There's none. And if management decides, look, this isn't working out, you're not pulling on the oars as hard as we thought you would, or you're not making things happen in the way we want it to happen. In fact, I'm just thinking some C-suite executive may get bounced out of Amazon because how could you not have figured this out?
That's a good point.
Right? They probably spent tens, if not hundreds of millions of dollars figuring out where to target this thing, and it took many, many years to do it. I'm sure they have a backup plan because you never know how politics are going to change. But over time, the point is these are big, big incentives for people, and they introduce all kinds of other issues when people's expectations get dashed, as sometimes plays out.
Well, it's interesting you say. So the exciting thing about this, we have a couple minutes left, is that there are so many different ways you could structure these, right? On a side note, which is kind of interesting, Jack, for years I've done residential financing, and I could tell you what's shown up in the last 4 or 5 years in a big way, and you almost see it every single day now, is the RSUs.
Yes.
So people are going, so what's so funny is the lenders have to get it, like,
what is that worth?
What's this RSU, what is it worth?
Restricted stock.
Restricted stock, right?
Yes.
And so they've grappled for years, and finally you have the major investors and lenders are finally adapting it and acknowledging those. But what's funny is this is something that's been around for a while.
It's been around for a while, but what's happened that's new, which really does change the game, and we should probably make this as a last point, and that's that there are private investors that are willing to take out the option grant value from the employee. Now, remember, here's an employee. Let's say they're early stage person. They, let's say, got 1% of the company, and they got it over, let's even call it a 5-year period with a 1-year cliff.
Right.
So 20% is vested after the year, and they have 1%, so let's just pretend that's 100,000 shares, just using some big numbers. And the value of the company after that year has actually gone up tenfold. It's like an Uber. It's just like a rocket ship.
Right.
There will be people who will say, I want some liquidity. Now, the company has no duty to give them cash or to do buyback.
Right.
But there's now this new phenomenon of internet-based trading of your vested rights. Places like SharePost and Zen Equity. Just do a search online. You'll find 20 of them.
Right.
And they pool together accredited investors, people that can take risk capital, and say to that employee, we will give you the cash to exercise the option, and then we want to own either with you or even 100%, depending on what we negotiate, that 20%, because we think you're on a rocket ship, you still have 80%. Why don't you buy that house you want? Why don't you buy that car you want? And believe me, there are people that are doing that. There are people that are cashing out. And this is creating for companies all kinds of concerns about who actually are our shareholders. Who are the shadows behind some of these employees?
Right.
So when you look at someone that comes to you
layers
and says,
and layers and layers.
I want to get a mortgage for $1 million. I want to put a down payment of $100,000. Maybe that's a low down payment. Maybe that's not enough down payment. But hey, what if I got somebody to help me with my restricted stock units and provide some cash? I'm not sure it's on a recourse basis or not, but is that a smart thing to do? You have to go through that with them and explain to them, okay, well, how's the tax stuff going to work? How much is it going to add to your down payment? Is it worth doing? How much are you giving up in the future? But I know people now that are looking at different opportunities and saying, hey, I want to diversify. I'm sitting on millions and millions. I mean, this is what people are saying. One of the consequences of Bezos' recent announced divorce is the market now going to be flooded with his wife saying, hey, I'm not going to be that close to the business anymore. Maybe she will be. Maybe they'll put her on the board of directors. Maybe she'll be one of their best rooters. But it's an interesting problem to have when you're a billionaire with that much stock, right?
It is. Well, as we wrap up today, as you could tell, you're listening to this podcast, there is so much to stock options, how you issue them. I mean, it's actually one of the most, it's very important. All this stuff's important, but for those, if you're listening to the podcast, what I would say, if you're thinking about starting a business or you know someone that is, this is a perfect example why you want to contact Jack and his firm and kind of talk through this stuff, because this is just another element when we did last year, right, the startups.
Yes.
Starting something new.
Yes.
I mean, this is just one component that is extremely important.
And it becomes a bigger and bigger issue as you're doing more and more hiring, because people will have expectations that you're going to match whatever it is that they could otherwise achieve at even a competitive business. And, of course, it becomes competitively important to make sure the talent feels like they're being rewarded, because that's how you build retention. And this is a form of currency that really has enabled Silicon Valley to thrive, even in startups that are sort of undercapitalized. Using this type of currency has enabled team formation and often people doing stuff that would not otherwise get funded. To get to the point of, the MVP and demonstration version that you can actually show to someone that's going to do the funding. So it is very important.
All right. Well, before we duck out, Jack, let everyone know where they could reach you and kind of quickly what your firm specializes in.
Sure. Jack Russo, Computer Law Group. We're in downtown Palo Alto in San Francisco, 650-327-9800. J Russo, or just Jack at computerlaw.com, JCK at computerlaw.com. We like to help everyone from the individual entrepreneur right up through the public company, although obviously companies get so big that they need to go with much bigger law firms, which we gladly hand off to. But we often stay still involved with the individual founding team and with members of the board of directors that need separate counsel, because the entity gets too big. I mean,
they go get those guys making $10 million a year.
Exactly. That's what they get. Well, they bring them in-house, and then those in-house guys hire other people at big firms. But yeah, it's an interesting world to watch if you go back and start looking at your classmates. How did these people?
That's amazing.
We were talking about this when we were looking at all these pictures that you have. Who is that person? Where did they end up anyway? Right?
He's got less hair, or he's got more gray hair.
Exactly.
All right. Thanks for tuning in today. Again, for more information, you could always go to RERadiolive.com. Take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.